Invisible markets running the world. They don't ring bells. They don't open or close. Most people never see them, yet they quietly shape prices, liquidity, and opportunity across the globe. While attention stays fixed on visible exchanges and headlines, another layer of markets has been running non-stop beneath the surface. Today, invisible markets move vast amounts of value without human supervision. They decide interest rates, rebalance capital, and trigger cascades of economic activity in milliseconds. To understand why this matters now, we have to look at how markets slipped out of sight and why the systems we no longer notice may be the ones shaping our future most decisively. Traditional markets were designed to be seen. Stock exchanges had floors. Traders shouted orders. Opening bells signaled participation. Visibility created trust. But as finance digitized, presence became unnecessary. Algorithms replaced traders. Speed replaced negotiation. And gradually, markets stopped needing witnesses. The reveal began when decentralized protocols automated market behavior entirely. Liquidity pools replaced order books. Pricing adjusted through formulas instead of bids. Trades executed instantly, without matching buyers and sellers directly. Markets no longer waited for participants to act. They responded automatically to incentives embedded in code. At first, these systems seemed niche, experimental, easy to overlook, but they carried a powerful advantage. They operated continuously, globally, and without discretion. Capital flowed wherever incentives were strongest. Risk adjusted itself in real time. There were no pauses for fear or optimism, only math responding to pressure. As adoption grew, these invisible markets began influencing visible ones. Prices on centralized exchanges reacted to movements happening elsewhere. Liquidity migrated without warning. Opportunities appeared and vanished in seconds. Human traders followed signals they didn't fully understand, chasing outcomes produced by systems they couldn't see. What emerged was a layered economy, one part human-facing, one part machine-driven. And the machine-driven layer was faster, quieter, and increasingly dominant. The question wasn't whether these invisible markets were powerful. It was whether anyone truly understood how much of the world's economic behavior they were already controlling. As invisible markets expanded, their influence became harder to trace and easier to feel. Sudden price movements appeared without warning. Liquidity vanished in moments of stress. Opportunities emerged and disappeared before most people could react. To outsiders, these shifts felt chaotic. Inside the systems, they were simply outcomes, formulas executing exactly as designed. The conflict emerged when people realized that these markets did not respond in narratives. They didn't care about news cycles, opinions, or sentiment. They reacted to incentives, imbalances, and mathematical thresholds. When conditions aligned, capital moved. When risk spiked, liquidity retreated. Human emotion had become secondary to machine logic. Traditional traders struggled to adapt. Strategies built around psychology and timing lost effectiveness against systems operating at machine speed. By the time a human noticed a trend, an invisible market had already exploited it. This created a growing asymmetry. Those who understood the systems thrived. Those who didn't felt perpetually late, reacting to outcomes rather than influencing them. Institutions felt the pressure as well. Market stability had long depended on pauses, circuit breakers, and discretionary intervention. Invisible markets had none of these. They did not slow down during panic. They did not stop to reassess. They executed relentlessly, sometimes amplifying volatility instead of dampening it. What once looked like efficiency now carried systemic risk. Inside these markets, feedback loops formed. One protocol fed into another. A small imbalance triggered automated trades across networks. Price movements cascaded, not because of human panic, but because code responded predictably to stress. Crashes and rallies could emerge without a single decision-maker involved. Yet defenders argued that invisibility was not danger. It was evolution. Markets had always been mechanisms for price discovery. Automation simply removed friction. Transparency existed for those willing to look. Every rule was visible in code. Every outcome traceable on-chain. The problem wasn't opacity, it was literacy. As these markets grew more complex, They became harder to separate from the broader economy. Lending rates adjusted autonomously. Asset valuations shifted continuously. Entire sectors began relying on invisible liquidity they did not control. The machine layer was no longer experimental. It was infrastructure. This raised a deeper concern. If markets operate beyond human perception, how does society govern risk? How do regulators intervene in systems that never pause? And how do individuals protect themselves when outcomes are decided by logic they don't understand? The invisible markets kept running, indifferent to these questions, but the pressure they created was building, quietly, steadily, toward a moment when their impact could no longer remain unseen. As invisible markets grew more intertwined, their behavior began to resemble a nervous system for the global economy. Signals traveled instantly. Capital reacted reflexively. Small disruptions echoed outward, magnified by automation until their effects felt far larger than their causes. What once would have been absorbed by human hesitation now propagated without resistance. The conflict intensified when these systems began colliding with human expectations. During moments of stress, invisible markets did not wait for reassurance. They withdrew liquidity at the first sign of imbalance. Prices adjusted brutally fast. For participants watching from the surface, it felt like the ground disappearing without warning. The market had moved on before fear could even register. Institutions found themselves increasingly reactive. Centralized exchanges mirrored movements originating elsewhere. Risk models struggled to account for systems that could not be paused or negotiated with. The traditional tools of stabilization, announcements, guidance, intervention, lost their immediacy. By the time humans responded, the invisible layer had already resolved the situation in its own terms. Inside the protocols, incentives ruled everything. Liquidity providers followed yields wherever they appeared, abandoning markets the moment conditions shifted. Arbitrage bots exploited inefficiencies instantly, flattening opportunities before humans could participate. Stability existed, but it was conditional and temporary, dependent on continuous alignment of incentives rather than trust or commitment. This dynamic reshaped behavior. Participants stopped thinking in terms of loyalty or long-term presence. They thought in terms of flow. Capital became nomadic, migrating at machine speed. Markets felt alive, but also restless, constantly adjusting to microscopic changes in pressure. Efficiency increased, but so did fragility. Emotionally, the gap widened between those inside the system and those observing it. Builders and advanced participants saw elegance in the design, systems responding exactly as intended. Others saw unpredictability, feeling locked out of decisions that affected them. The same mechanisms that remove human bias also remove human intuition. As invisible markets absorb more responsibility, their roles shifted from optional tools to unavoidable forces. They no longer supplemented traditional finance. They influenced it. Prices, rates, and liquidity increasingly reflected machine-driven logic first, with human interpretation following behind. The build-up reached a critical realization. These markets were not hidden because they were secret. They were invisible because they operated at a scale and speed beyond human perception. And the more the world relied on them, the more important it became to understand what happened when machines, not people, set the rhythm of value itself. The turning point arrived when the world finally acknowledged that invisible markets were no longer a background process. They were the engine. What once felt like experimental infrastructure had become a dominant force shaping liquidity, pricing, and risk across the global economy. The climax revealed a paradox at the heart of these systems. Invisible markets were incredibly efficient, yet profoundly indifferent. They optimized relentlessly, but they did not care who was affected. Stability existed, but only as long as incentives aligned. When alignment broke, the response was immediate and absolute. No hesitation, no warning, just execution. In the aftermath, understanding replaced denial. Institutions began studying on-chain behavior instead of ignoring it. Risk models evolved to account for autonomous liquidity. Builders introduced friction intentionally, slowing execution to prevent cascades. Transparency became the new safeguard, not control. The goal was no longer to stop invisible markets, but to live with them safely. The resolution reframed the role of humans in an automated economy. People were no longer market operators. They became system designers, incentive architects, and risk interpreters. Power shifted from those who could react fastest to those who could design resilience into systems that never sleep. What endured was not the illusion of control, but a new form of awareness. Invisible markets did not remove responsibility. They intensified it. Every parameter mattered. Every assumption echoed at scale. And every line of code carried consequences far beyond its creators. The markets running the world were never truly invisible. They were simply operating at a layer most people never learned to see. And in a future shaped by automation, seeing clearly may be the most valuable skill of all. Subscribe to join the journey.